Hi everyone, hope you all are well. Big week in our family. Our little girl started prep. Gosh, it goes quick. So proud of her. She was very nervous, but by the end of the week, she's like, Mum, I can walk in on my own now. Crazy. If you're not already following us on our socials, that is Future Accounting, please follow and share so we can help as many possible people as possible. A hot topic in the accounting world is the potential tax reform, which is well overdue. However, one I wanted to touch on today was the potential overhaul of the capital gains regime. Few things in this space to be mindful of. Currently, if you own a home and it's your main residence, regardless of how long you have owned it for, it's capital gains tax-free under the main residence exemption. This is now being discussed, and potential changes may see this exemption either completely removed or scaled back significantly. So, for example, some of the suggestions are to allow the first, say, $300,000 to be exempt, but over that taxed at your marginal tax rate. So we need to watch this space carefully. The other is the 50% discount. So currently, if you own an investment asset such as property, shares or other capital assets, and you have held those assets for more than 12 months, you get a 50% discount on the capital gain you make. So you get taxed on just 50% of the gain at your marginal tax rate. There are now talks of reducing this to 25%, scrapping it altogether, or reducing it slowly over a number of years. So to break that down, if you own an investment property that you purchased for, say, $500,000, you hold this property for a number of years and then sell for $1 million. So you've made a gain of $500,000. Under the current rules, you get to discount that by 50%. So instead of being taxed on $500,000, you are taxed on $250,000. Capital gains is not a separate tax, so instead it's actually taxed at your marginal tax rate. So your usual taxable income, that is your income less your allowed deductions, plus the net capital gain will equal your taxable income, and that's what tax is paid. So potentially the highest marginal tax rate. So if the 50% discount is removed, we are talking significant amounts of tax on investments sold, potentially up to nearly 50%. If you factor in the Medicare levy. So this is significant. This is potentially only the beginning. Small business concessions will no doubt be on the radar. They've been talked about a lot. We'll keep you up to date. The budget will be very interesting this year to hear what is announced. Planning early is always the best approach, so please ensure you reach out to us, book an annual review meeting, come and have a chat about your circumstances so we can help you as much as possible to retain your wealth and your hard-earned dollars. Rather than it going to governments for years, both sides, doesn't matter who have overspent and wasted so much of taxpayer hard-earned dollars.